to CA Insights with Varda. In this channel, we discuss about various concepts related to CA course and other related matters. In first few videos, we will see about ratio analysis and its applications and various other factors related to it. And in future videos, we will also discuss about various concepts, various related concepts. First, why do we require ratio analysis? First, when we need to invest in company, or when we are an employee of company, we are interested in the company, how it performs and what is its current position. So in order to satisfy that need, company prepares. Also government requires the details of the company so that they can tax it accordingly. So in order to solve the needs of various stakeholders, company prepares financial statements. Financial statements comprises of 5 things: balance sheet, profit and loss account, and notes to accounts. And the other 2 statements, cash flow statements or fund flow statements, statements of changes from equity. These are collectively called financial statements. These metrics gives how the company perform, how the company operates, and what is the current position of the company. It helps us to compare their data with other competitors in the market, so that we can make decisions accordingly. But they alone are not sufficient for any investor. So in order to give a more valuable insight, we need ratio analysis. What do we basically do in ratio analysis? We basically ratio. What is basically meant by ratio? Ratio is a proportion of 2 numbers. It gives relationship between 2 numbers. That if 2 numbers are not related in any way, they don't give a meaningful results. So ratio analysis is basically a comparison between 2 numbers which are related directly or indirectly and give a meaningful insight to us. So ratio analysis is basically defined by Benjamin Graham, who is known as father of value investing, or he is also called father of ratio analysis. He authored 2 books. The first book is Intelligent Investors, which is very famous among investors. And second, he co-authored security analysis book. His famous one of his famous disciples is Warren Buffett, who is one among the topmost richest person in the world. He basically used 3 ratios to analyze the companies. They are current ratio, price earnings ratio, and earnings per share. He used 3 ratios in order to analyze securities. Okay. Ratio analysis basically is classified into 4 types. First, liquidity ratio or short-term solvency ratio. These ratios are used to find the solvency, short-term solvency of the companies or entities. Second, leverage ratios or long-term solvency ratios. These ratios are used to find the long-term solvency of the company. Third, performance ratios or turnover ratios. Fourth, profitability ratios. In this video, we are going to discuss about first 2 things: short-term solvency ratios and long-term solvency ratios. In liquidity ratios, there are 5 ratios: current ratio, quick ratio or acid test ratio, cash ratio or uh, cash ratio or absolute liquidity ratio, fourth, basic defense interval or interval measure. Fifth, net working capital. First, current ratio. In this ratio, the objective of this ratio is to find whether the current assets, short term assets, uh, are enough to meet out the current obligations. So the formula is current assets by current liabilities. Current assets includes all kind of current assets, uh, uh, like um, debtors, cash and bank balances, prepaid expenses, and all other current assets. Similarly, current liabilities includes all current liabilities including provisions. So the optimum current ratio is 2:1. Second, quick ratio. Quick ratio or acid test ratio. Acid test ratio, the acid test is conducted basically to test the materials. In the same way, quick ratio, the formulas, I will tell the formula first. Quick ratio is quick assets by current liabilities. What is meant by quick assets? When we exclude from current assets, when we exclude inventories and prepaid expenses, it is called quick assets. Why do we first of all exclude inventories and prepaid expenses? Inventories and prepaid expenses are not readily convertible into cash, whereas other things are readily convertible into cash. So we include those assets which are readily convertible into cash, whether they are enough to meet out the current obligations. The objective of quick ratio is to find out whether if we are not getting money, assuming we are not getting generating any resource or revenue, then whether the current quick assets which are readily convertible into cash are enough to meet out the current obligations. This is the objective behind quick ratio. So the formula is quick assets by current liabilities. Third ratio is absolute liquidity ratio or cash ratio. In this ratio is furthermore filtering current assets. In current assets, we take only cash and bank balances and current investments, which are marketable within 3 months. Those are called current investments. Those securities which are convertible, which are marketable within 3 months, are called current investments. And cash and bank balances, whether these things which are readily available in cash, whether these are enough to meet out whether these are enough to meet out the current obligations. This is the objective behind cash ratio. The absolute liquidity is, the name itself defines, they are readily liquid, so that we can meet out the current obligations. Fourth, basic defense interval or interval measure. In this ratio, the numerator is cash and bank balances and marketable securities divided by net operating expenses, daily operating expenses. What are meant by operating expenses is all expenses of the year, which are administration expenses, selling expenses. All expenses are included except depreciation. Divided by number of days in a year will give you operating expenses. So when you divide cash and bank balances, cash and bank balance and marketable securities divided by operating expenses, it will give you for how many days those cash and bank balance is sufficient to cover those expenses. So it gives number of days. It gives a situation where if you do not generate any revenue, hypothetical situation where you do not generate any revenue, even though you do not generate any revenue, are you capable of covering covering those operating expenses with the available cash and marketable securities? This is the objective behind basic defense interval ratio. Fifth ratio is networking capital ratio. This is current assets minus current liabilities. Short term borrowers will basically see this ratio, whether the current assets are enough to cover current liabilities, so that if it is positive, it must be positive, then only it indicates that your liquidity is good enough to current meet out your obligations. This ratio must be positive. So the we will once again summarize the ratios in liquidity covered under the category of liquidity. First, current ratio. Second, in current ratio, the formula is current asset by current liability. Second, cash ratio or absolute liquidity ratio, where cash and bank balances plus marketable securities divided or current investment divided by current liabilities. Third, quick ratio. Quick ratio or acid test ratio, where current assets minus inventories minus prepaid expenses divided by current liabilities. Fourth, basic defense interval or interval measure, where cash and bank balances plus marketable securities divided by operating expenses, and operating expenses stands for all expenses, administration expenses, selling expenses, all expenses minus depreciation, divided by number of days in a year. Generally, while computing answers, if nothing is given, we will take 360 days in a year. If specifically given 365 days, we will take 365 days in a year. Fifth, networking capital must be positive, and it is current asset minus current liabilities, and also the optimum current ratio, current asset by current liability, must be 2:1. Next, we are going to see leverage ratios or long-term solvency ratios. In this ratio also, we are going to see 5 ratios: equity ratio, debt to equity ratio, capital gearing ratio, and proprietary ratio. First, equity ratio. Equity ratio formula is shareholders equity divided by net assets. Shareholders equity consists of equity, share capital, reserves and surplus, excluding fictitious assets. Fictitious assets basically mean accumulated expenses which are not written off, like preliminary expenses at the time of incorporation. These must be written off, so we reduce it from available surplus. So equity, share capital plus reserves and surplus includes all reserves and surplus, excluding those fictitious assets, divided by net assets. Net assets includes both fixed assets and current assets, but current assets means net current assets. Current assets excess over current liabilities, and also net fixed assets. The objective behind this ratio is to find whether the available assets are enough, whether the how much the equity shareholders funds are how much the assets are funded by shareholders funds. Total assets are funded by shareholders funds. In order to get that proportion, we use this ratio. Higher the equity ratio, the lower the potential in lenders or lenders risk. So when lenders need to lend you money in long term basis, they will see whether the equity ratio is how much is the equity ratio. If it is more than 1, If it is in excess, they will lend you, because they are sure that the assets are more funded by equity shareholders funds, so they will have less risk. Second, debt ratio. Debt ratio, total debt means inclusive of all debts. Total debt, it includes both current liabilities, also long term liabilities, divided by net assets. This is another, if the net assets are funded by two things. Basically, we the balance sheet, in balance sheet, we have two sides, liabilities, assets. It is nothing but how the funds are procured, how it is invested. So net assets is asset side. Yeah, assets, these assets are funded by two things. One is equity and other is debt. The equity ratio shows how much the equity is funding assets. Debt ratio shows how much the debt is funding assets. So it is advisable that more equity and less debt will give investors, lenders good impact that assets are more financed by equity than outsiders funds. So debt assets is total debt, inclusive of both long term debt and short term debt, divided by equity. The debt to equity, this is total debt divided by shareholders equity. The shareholders equity is share capital, reserves and surplus. Total debts is total outstanding debts, whether it may be short term or long term. This is to understand how much the debt is to equity, so that we can, for example, if we take one as total funds available to us, the equity shows how much equities of one, that if we take one as total funds available to invest, of that how much is equity ratios gives this number, how much is debt of that one, debt ratios gives that number of that one, the debt to equity is how much debt to equity. So it is advisable debt to equity ratio and debt ratio to be lowest and equity ratio to be positive, highest. Fourth, capital gearing ratio. This ratio is specifically for interest bearing loans, which are in terms long in nature of long terms. For example, preference share capital, debentures and other borrowed funds are long term funds. Preference share capital is also a kind of long term funds. We give we give preference dividend before equity shareholders at a specified rate. They are also interest bearing securities. So preference share capital plus debentures and other long term funds divided by shareholders funds, less fictitious losses. So capital gearing is another variant of debt to equity, but the difference between debt to equity and capital gearing is that in debt to equity, the debt is we take all kinds of debt. In capital gearing ratio, we take interest bearing security debts, so that we can, in this ratio, the objective in this ratio means debt to equity ratio, the objective is to find how much debt to finance, the how much it is, how much the proportion are. In capital gearing ratio, how much equity shareholders funds is are capable to cover those interest bearing securities. Last ratio is proprietary ratio. It is proprietary funds, which is equity share capital, plus reserves and surplus, and also it includes preference share capital divided by total assets. Total assets excluding fictitious assets. So once again summarizing all the leverage ratios: equity ratio is shareholders funds divided by net assets. uh, Second, debt ratio, total debts divided by net assets. Third, debt to equity ratios, the total debt divided by equity shareholders funds. Fourth, capital gearing ratio, preference share capital, debentures to other outstanding other borrowed funds divided by divided by equity share capital plus reserves and surplus excluding fictitious assets. Wherever we are using shareholders funds, we should exclude fictitious assets. Similarly, when we are using assets in denominator, we also remove fictitious assets from them. So proprietary ratio is shareholders funds divided by total assets excluding fictitious assets. In leverage ratios, there are two classifications. First, we saw capital structure ratios, which are first subclassification of leverage ratios or long-term solvency ratios. We are going to see coverage ratios, which are second subclassification of leverage ratios. In coverage ratios, there are 5 types of coverage ratios: debt service coverage ratios, fixed charges coverage ratios, interest coverage ratio, preference dividend coverage ratios, equity dividend coverage ratios. What are coverage ratios? Coverage ratios are indicates that how much times the funds are available to cover those expenses or appropriations. So how the number of times, more number of times the ratio gives, it is the cushion for the company so as to pay those expenses. If the ratios are less, then it means that we are running out of expenses or more risk, or we are running out of funds to cover those expenses, or we are of more risk to cover those expenses. First, debt service coverage ratio. Formula is profit after tax plus interest plus non-cash expenses divided by interest plus installments. The objective behind this ratio is that the available funds which whether the available funds are enough to cover those interest which are payable in every month, plus installments which are also payable in every installments. Installments includes interest and principal portions. So whether interest and installment, how much times the funds are available to cover those things is the objective behind this ratio. Another variant of this debt service coverage ratio is fixed charges coverage ratio. The formula is similar to this, which is EBIT, earnings before interest and tax, or PBIT, profit before interest and tax, add back depreciation. This is numerator, divided by interest plus repayment of loan, which so EBIT plus depreciation divided by interest plus repayment of loan. This is the another variant of debt service coverage ratio. This ratio is called fixed charges coverage ratio. Both the ratios, more the number of times is advisable. Interest coverage ratio. What is interest coverage ratio means? EBIT divided by EBIT means earnings before interest and tax divided by interest. It is how much times the amount available to cover the interest payment. We take EBIT, which is before payment of interest, earnings before payment of interest, to calculate this ratio. Next, preference dividend coverage ratio and equity dividend coverage ratio. The dividends are generally paid after all expenses and tax. So we take profit after tax or profit after tax or earnings after tax. We call EAT or PAT. We take this amount. Whether this amount is sufficient to cover this dividend. This is the rationale behind these two ratios. Preference dividend coverage ratio is profit after tax divided by preference dividend. Equity dividend coverage ratio is profit after tax minus preference dividend divided by equity dividend. Why should we reduce preference dividend is that in that profit after tax also we reduce preference dividend. Only after paying preference dividend we can pay equity dividend. So only we are reducing preference dividend from the numerator. So formulas profit after tax minus preference dividend. So the we will summarize 5 formula here. First, we will classify this into 2 types. First, coverage ratio of interest. Water coverage ratio of interest. Debt service coverage ratio. Formula profit after tax plus interest plus non-cash expenses divided by interest plus installment. Second, fixed charges coverage ratio, EBIT plus depreciation divided by interest plus repayment of loan. Third, interest coverage ratio, profit before interest and tax divided by interest. Second is dividend appropriation, preference dividend coverage ratio, equity dividend coverage ratio. Preference dividend coverage ratio formulas PAT or EAT divided by preference dividend. Equity dividend coverage ratio PAT or EAT minus preference dividend divided by equity dividend. So these are the 15 ratios we have seen in this video. In upcoming video we will further see another two remaining classification of ratio analysis and another other applications of financial ratio analysis and limitations of ratio analysis. Thank you. Have a nice day.